Good morning, everyone, and welcome to Federal Taxation and Business Entity Law Aspects of Buying and Selling Businesses. I'm Vinny Savatello, Communications Manager for the New Jersey Business and Industry Association. With us today is Robert S. Schwartz, Esquire, from Lindaberry, McCormick, Estabrook, and Cooper, PC. A few housekeeping matters before we get started. Today's webinar is being recorded and will be emailed to you tomorrow along with the PowerPoint for today's presentation, so be on the lookout for those. I'd also like to draw your attention to the Questions tab. Robert would be happy to take all of your questions, so don't hesitate to write them in as they come to you. And I mean that. Write them in as they come to you and don't wait until the end, because by the time we hit the Q&A, you might have forgotten what you wanted to know. So now let's get things started. Robert?
Hi, good morning. My name's Robert Schwartz. Thank you for tuning in today. I'm an attorney licensed to practice in New Jersey, Pennsylvania, New York, and Florida, and a shareholder in Lindaberry, McCormick, Estabrook, and Cooper. Our firm is well established in New Jersey, having been founded in Elizabeth by Joe Lindaberry, Frank McCormick, and Ken Estabrook in 1954. We have attorneys in 3 office locations in the state: Westfield, Summit, and Red Bank. The topic is federal New Jersey taxation and business entity law aspects of buying and selling businesses. I'm going to focus on federal and New Jersey taxation. I will sometimes compare the New Jersey tax consequences to those of Pennsylvania and Florida. I will be taking into account the current federal and state tax law, and in comparison, the federal tax law that will likely be effective January 1, 2018, and based on the House Ways and Means Committee House Rule 1 Tax Cuts and Jobs Act. And as to New Jersey 2018 taxation, I will be taking into account Governor-elect Murphy's plans for a 10.75% top marginal rate beginning 2018. When a business is sold, there's ordinarily a substantial amount of taxable income generated by the sale. Taxes due so substantially reduce the gross sale proceeds that it is important for all business owners to be familiar with the tax consequences, or at least know who to call for accurate analysis. There are 3 important tax attributes or concepts, basic concepts, coming into play in business sale transactions. They are basis or tax basis, adjusted basis, and amount realized. They're defined as follows. A tax basis is the cost of an ownership interest in a business or the cost of a business asset. The adjusted tax basis or adjusted basis is when that original tax cost, be it of buying an ownership interest or being it buying a business asset, when that original cost is adjusted downward. In the case of depreciable business assets, the basis is adjusted downward each year as the company takes corporate tax depreciation deductions. Similarly, business interests can have varying adjusted bases compared to the original cost. Amount realized is simply the total amount of the sale proceeds from the sale of an asset or the sale of an ownership interest. That's the amount realized. If the adjusted basis is more than the amount realized, a loss results from the sale transaction. If the amount realized is more than the adjusted basis, a gain results. These fundamentals out of the way, there follows a discussion of the important details concerning federal, New Jersey, and for comparison's sake, Pennsylvania and Florida tax consequences of business purchase and sale transaction. A prospective seller's sale proceeds after taxes depends upon the type of legal entity or entities through which the business has been operated, as well as the precise legal form of the transaction. A prospective buyer's tax consequences depend upon the precise form of the transaction and/or tax elections made or foregone by the buyer. As noted earlier, emerging federal income tax reduction is a very important consideration at this time. In the examples to follow, I compare today's 35% federal corporate income tax rate to a January 1st, 2018 effective rate of 20%. I assume the same individual 20% capital gain tax rate today and in 2018, as well as the same 3.8% unearned income Medicare contributions tax. I sometimes will refer to the 20% capital gain tax and the 3.8% unearned income Medicare contributions tax inaccurately, but simply as a 23.8% capital gain tax. I compare today's married filing a joint return ordinary income top rate of 39.6% on taxable income over $470,000 with 2018's possible top 39.6% ordinary income tax rate on taxable income starting at $1 million. That's a $530,000 difference before the top rate is effective. I assume for 2018 the elimination of the individual alternative minimum tax and the elimination of the state and in some cases local income tax deduction for individuals. I assume an increase in New Jersey's top gross income tax rate from today's 8.97% to 10.75% on income over $1 million. All numbers in the flowing example to follow are approximations. I talked about the form of the business entity, the kind of business entity, and the form of the business transaction. I'm going to start with a C corporation as the form of business entity and the transaction type, a corporate asset sale. Under current federal tax law, if the business entity is a corporate income taxpayer, which is commonly known as a C corporation, the difference between the business asset sale proceeds, put another way, amount realized, and the adjusted tax basis of the corporation's business assets, that difference determined as of the closing date is subject to the 35% federal corporate tax. For example, if the sale proceeds are $10 million and the business assets adjusted tax basis is $2 million, the after federal corporate tax proceeds of the corporation are $7.2 million. If at closing the federal corporate tax rate is 20% compared to 35%, the after federal tax proceeds to the corporation are $8.4 million, a $1.2 million increase. If the corporation's business is conducted in New Jersey or by comparison in Pennsylvania, after state corporate income taxes at the present time, taxation proceeds are 6.7 and 6.7 respectively, approximately. With a federal corporate tax rate reduction to 20%, after state corporate income taxes, the proceeds are 7.8 million New Jersey and 7.7 million Pennsylvania. The difference is accounted for by New Jersey's 9% corporate tax rate compared to Pennsylvania's 10% rate. The tax character of a C corporation's asset sale is generating ordinary income or capital gain to the corporation is not typically a material consideration in a business purchase and sale. The corporate tax rate is the same. An exception occurs what if the corporation has a capital loss carry forward or a capital loss for the year of sale apart from the tax consequences of the asset sale. Since corporate capital losses cannot offset corporate ordinary income, a seller needs to pay attention to the Internal Revenue Code Section 1060 sale price allocation among the business assets sold in order to minimize taxes by supportable sales price allocations to capital gain assets. In a situation where the selling corporation has operating loss carryovers or an operating loss for the year of sale, these operating losses reduce both ordinary income and capital gains. The effective corporate tax rate is thus lower than a nominal 35% rate on C corporation business asset sales where operating losses are present. The presence of these losses can factor into sales price negotiation. Ordinarily, a C corporation asset sale leads to a liquidation of corporate assets and a dissolution of the corporation. This transaction results in shareholder capital gain. The liquidating corporation itself is also subject to taxable gain, but only if it distributes appreciated assets, which by definition excludes cash sale proceeds. Hence, additional corporate taxation results only in untypical situations where a corporation has not sold one or more appreciated assets and distributes the same in liquidation. Assuming in our example $6.7 million is distributed to New Jersey shareholders, a federal capital gains tax of 23.8% leaves after-tax sale proceeds of $5.1 million for New Jersey resident shareholders on the $1 million asset sale. Looking at New Jersey or Pennsylvania for comparison as states of individual shareholder tax residence or domicile, the effective income tax rates today to shareholders on the corporate liquidation proceeds are roughly 6% and 2% respectively. Today, a $5.1 million liquidating distribution after New Jersey state tax to the shareholders leaves $4.8 million. $5 million is left for Pennsylvania resident shareholders on the $10 million sale price. Assuming a 2018 sale, a 2018 20% federal corporate tax rate, and a federal capital gain rate of 23.8%, the after federal tax liquidation proceeds to shareholders is $5.9 million, up from $5.1 million, before taking into account state personal income taxes on the liquidating distribution. If, for example, the shareholders happen to be Florida residents, there would be no individual state personal income taxes on receipt of the liquidating distribution. Assuming the same federal individual capital gains rate of 23.8% in 2018, coupled with a 20% federal corporate tax rate, and further assuming the federal deduction for state income taxes is eliminated and New Jersey's top rate becomes 10.75%, the $5.9 million of after federal tax liquidating proceeds results in a net of $5.3 million for the New Jersey resident shareholder and $5.7 million for the Pennsylvania resident on a $10 million sale price for a 2018 business sale. C corporation liquidating distributions often could be put off until a later year, thereby deferring shareholder federal taxation as well as state taxation. Possibly, the state's income taxes can be avoided by a shareholder in the meantime changing state residency and domicile pre-corporate liquidation. If buyer promissory notes made to the order of the C corporation are part of the sale proceeds, a common circumstance, deferral of corporate taxation takes place unless and until the corporation distributes the notes to its shareholders, except in the case of a deferred distribution of the buyer promissory notes, the corporation is taxed for the years payments are made on a note in the meantime. The distribution by the corporation of the seller notes triggers the remainder of the deferred portion of corporate taxation. Deferral of shareholder taxation continues post-distribution, but only if the directors had timely adopted by resolution a corporate 12-month plan of liquidation and the corporation distributes the notes along with any other corporate assets within the 12-month period in complete corporate asset liquidation. Timely means the director resolutions are adopted at any time before the sale closing date, not after. Shareholder tax deferral, limited as it is by the requirement of a liquidation distribution of buyer notes within 12 months of a board resolution made before the sale closes, can be and probably will be without tax planning at cross purposes with a shareholder state residence shift to avoid state personal income taxation. Similarly, making use of corporate liquidating trusts in order to accomplish a timely corporate complete liquidation can be a tax efficient action step. The second common form of business sale transaction is a C corporation stock sale. If C corporation stock is sold for $10 million and assuming a zero adjusted tax basis in the stock compared to $2 million worth of corporate asset tax basis, after a 23.8% capital gains tax, the federal capital gains tax, stock sale proceeds are $7.6 million. Contrast this to $5.1 million for shareholders after only federal tax with a C corporation asset sale. For 2018, after federal tax proceeds on a C corporation stock sale remain $7.6 million, unless the 3.8 million Medicare contribution tax, the 3.8% Medicare contribution tax is repealed as part of any 2018 changes to the Affordable Care Act. These points about lesser taxation in the case of a C corporation stock sale assume the sale agreement prohibits the buyer from making a seller adverse Internal Revenue Code Section 338G election. This election benefits the buyer, but triggers corporate taxation on the stock sale, in addition to the individual shareholder taxation. Let's move to a stock sale in 2018. Assume the federal deduction for state income taxes is eliminated and New Jersey's top tax bracket rises to 10.75%. The proceeds to New Jersey resident non-corporate shareholders are $6.5 million. Contrast this to $5.3 million in a 2018 C Corporation asset sale transaction where the shareholders are New Jersey residents. After Pennsylvania income tax, the proceeds to Pennsylvania resident non-corporate shareholders on a 2018 stock sale is $7.3 million, $800,000 more, reflecting Pennsylvania's lower 3% income tax rate compared to New Jersey's anticipated 10.75% rate. Contrast this Pennsylvania result to the $5.7 million if a C corporation sold its assets in a Pennsylvania transaction during 2018. Shareholders selling stock who establish residency and domicile in a no income tax state such as Florida in sufficient time pre-sale, such as safely before the year of sale closing, pay no state income tax on the $10 million stock sale proceeds. Most often, not always, prospective buyers prefer to buy the assets of a corporation because several Internal Revenue Code sections provide for what is effectively a straight line income tax deduction of the purchase price over a maximum of 15 years. A prospective buyer calculating its internal rates of return on investment may or should factor this deductibility into the pricing offer. A comparative analysis of seller tax cost, buyer tax savings sometimes leads to a lower price for a C corporation stock sale than for an asset sale, but the selling shareholders have more after-tax funds than if C corporation corporate assets were sold. To illustrate this paradoxical point using our example, refer back to the $10 million asset sale in today's tax law. There remains $4.8 million for a New Jersey resident shareholder and $5 million for a Pennsylvania resident shareholder. If the price instead of being $10 million is $8 million, but for stock rather than C corporation assets, under today's tax law, the New Jersey resident seller keeps $5.6 million compared to $4.8 million, and the Pennsylvania resident keeps $5.9 million compared to $5 million, despite the $2 million less sale price for stock compared to corporate assets. The difference, of course, reflects the double taxation of C corporation business income and sale income and the taxation of their shareholders. Given the tax savings to sellers, it is well within the realm of reason a buyer would agree to pay $2 million less for the business and forego the present value of as much as $10 million in future tax deductions. Maybe the buyer would agree to pay less than the $2 million less for the business, in which case the after-tax proceeds to the shareholder selling stock are a larger amount. Despite the tremendous impact of business sale taxation as just illustrated, it is important to keep in mind that the economics of the buyer's offer, taxation aside, is the proper starting point for any bid price for a business. The seller too should start from this perspective. In fairness to the sellers, however, a seller's more immediate and material taxation is, or at least should be, a greater consideration than a buyer's future tax benefits when refining a sale transaction legal structure and pricing for the sale. I'm now going to turn to another business sale paradigm, the S corporation asset sale. If the business entity is an S corporation for at least 5 full years pre-closing, the business sale is not taxed at the high level of income taxation in the case of a C corporation. Returning to the example, a $10 million S corporation asset sale generating $8 million in taxable gain is taxed only once and at the shareholders' tax rates for the year of sale. The tax character of the S corporation asset sale gain as higher ordinary income taxable or lower capital gain taxable is determined at the corporate asset level. Owing to both these rules, that the shareholders pay the taxes on the sale gain and the tax character is higher taxed ordinary income or lower tax capital gain is determined at the corporate level. The Section 1060 purchase price allocation among the acquired assets of the S corporation, which obviously would be the tangible assets, but also intangible assets such as goodwill, determines the shareholders' effective blended tax rate as between the capital gains and ordinary income rates. At today's federal tax rates, a blended rate lies between the federal 39.6% ordinary income tax rate and a 23.8% capital gains rate. If there is little in the way of depreciated tangible assets being sold, little of the gain is subject to the 39.6 ordinary income rate to the shareholders. The more favorable 23.8% rate predominates. If the business involves a great deal of depreciated assets, such as considerable plant, machinery, and equipment, and if that property retains a high market value, such as often does plant, but not usually, but sometimes machinery or equipment, the ordinary income rate component is higher relative to the capital gain component. When we return to a $10 million corporate asset sale generating $8 million of taxable gain, and assuming an S corporation is the selling business, assuming an S corporation shareholder's blended federal income tax rate of 30%, after federal taxation, S corporation shareholders keep a much higher $7.6 million post corporate liquidation and dissolution than $5.1 million kept with a C corporation asset sale. Looking only to federal tax rates for 2018, slightly more than $7.6 million of proceeds remains, presuming as I do, today's 39.6% tax bracket will remain in place for 2018, but will start at $1 million of taxable income rather than $470,000 of taxable income this year. Meanwhile, with the asset purchase, the buyer obtains the tax benefit of up to a 15-year straight line deduction of $10 million of the purchase price. An S corporation stock sale. For one or more non-tax reasons, such as non-assignable contracts and licenses, the structure of the business sale transaction often must be the shareholder's sale of their S corporation stock. The buyer will usually want to make a Section 338G or alternatively, a Section 338H10 election, because either election transforms what is a stock sale for all other legal purposes into an asset sale for federal and state income tax purposes. Often, not always, the selling shareholders have no after-tax reasons not to agree to the buyer's request for a Section 338H10 election in a situation of an S corporation. The typical exception is if shareholder stock adjusted tax basis materially exceeds S corporation asset basis. This usually occurs if a shareholder dies and the sale occurs within a few years after the date of death. A Section 338H10 election causes the S corporation asset sale gain to be computed at the corporate level as if the S corporation's assets are being sold. A Section 338H10 election thus causes resulting taxable asset sale gains to be passed through to the S corporation shareholders' federal and state tax returns. If there is not a material amount of depreciated valuable taxable assets being sold, which is frequently the case, corporate level ordinary income versus capital gain characterization does not materially increase shareholders' federal taxation compared to if they sold the stock, which is a capital gains taxation only event. If the ordinary income component is material, however, then a purchase price increase is often warranted, as the price a buyer pays for the tax benefits to it of the Section 338H10 election in connection with a sale of S corporation stock. Finally, a Section 338H10 election also results in a deemed taxable liquidation of the S corporation. The resulting increase in the shareholders' stock tax basis arising from the income and gain passed through to them of the tax consequences of the election most often offsets the deemed cash distribution, resulting in no additional taxation to the shareholders. Note that a mere 338G election, which a buyer may propose, and which can be made unilaterally by a buyer, is always to be avoided by S corporation stock sellers because it triggers S corporation level income taxation at the same time the S corporation shareholders pay taxes. Sellers find simultaneous double taxation a disaster, and understandably so. I'm going to talk now about the S corporation with built-in gains. The S corporation with built-in gains is not too commonly encountered at the present time compared to a decade or so ago. However, if the business entity is an S corporation, but S corporation status had been in effect for less than 5 full years at the date of the closing, there occurs very high income taxation in the case of a corporate asset sale. Return to the example of $8 million of corporate asset sale gain, $10 million price, $2 million adjusted tax basis, and assume the S corporation with built-in gains liquidates during the same year as the sale closing. Further assume all of the $8 million gain is built-in gain because the owner of the S Corp has no good evidence to the contrary, which is the usual situation. The 35% corporate tax imposed on $8 million of gain results in corporate tax of $2.8 million. Meanwhile, simultaneously, the shareholders have pass-through gain of $8 million at a blended 39.6% ordinary income, 23.8% capital gains rate. At a blended rate of 30%, the individual tax is a tentative $2.4 million. Total tentative federal taxes are $5.2 million on the $10 million sale. In addition, the owner's stock basis increases from 0 to 8 million to account for the fact that 8 million of taxable gain passed through to the S corporation shareholder as taxable income. Assuming a corporate liquidation actually occurs during the same year as the sale, upon a corporate distribution of 7.2 million, the resulting 800,000 of shareholder capital loss, 8 million stock basis minus 7.2 million received, reduces the tentative tax amount by the same 800,000. Consequently, the tentative $8 million shareholder taxable gain is reduced to 2.7 million. At an effective 30% tax rate, the tax rate approximates 1.9 million rather than 2.4 million. After all federal taxes, in case of a timely S corporation liquidation, the original 10 million sale proceeds becomes 5.3 million rather than 5.2 million. This circumstance is known as a built-in gains problem. By contrast, an S corporation stock sale without a Section 338G or a Section 338H10 election escapes built-in gains taxation. So too does waiting until 60 months after the S corporation election became effective. An effective date of an S corporation election is ordinarily a January 1st date. I'm now going to move to the tax consequences of a sale of member interests in limited liability companies. Limited liability companies have become an ever increasingly present form of business entity. If the business is conducted through a limited liability company, the sale of member interests results in capital gain taxation to the sellers, except if and to the extent the business operation possesses what's known as substantially appreciated inventory and accounts receivable at the time of closing. To the extent of these assets, an allocated amount of the sale gain is taxed to the owners or members at ordinary income tax rates. Ordinarily, the effective rate is skewed toward the 23.8% capital gains rate. If and to the extent the limited liability company has borrowing repayment obligations at the time of closing, the outstanding amount is considered additional sale proceeds, additional amount realized. This rule is inapplicable to C or S corporation stock sales. However, it is not necessarily a tax detriment because ordinarily limited liability company borrowings increase member interests tax basis, unlike with borrowings by corporations vis-a-vis stockholders. Even if corporate borrowings by an S corporation are guaranteed by the shareholders, for example. On the buyer side of a purchase of member interest in a limited liability company, the buyer ordinarily makes a Section 754 election to obtain the purchase price basis of the company assets, the purchase price including the company's borrowing repayment obligations or other qualifying liabilities extant at the time of closing. The tax benefit to the buyer of the Section 754 election is income tax deduction of the purchase price, including the qualifying liabilities, over a maximum of 15 years, the same as in the case of a Section 338H10 election in the corporation stock purchase context. Unlike with a Section 338H10 election, however, a Section 754 election does not cause the sale of member interest in a limited liability company to be treated as a sale of the company assets for federal, corporate, and individual tax purposes. Same with the state income tax laws. Limited liability company asset sales. If the form of the business purchase and sale transaction is a limited liability company selling its assets, and no election had been filed to treat the limited liability company as an association taxable as a corporation, an unusual but sometimes encountered confusing phenomenon. The buyer similarly obtains the tax deduction for the purchase price of the purchased assets. The purchase price also includes the limited liability company's borrowing repayment obligations and other qualifying liabilities, if and to the extent those liabilities are assumed by the buyer or the limited liability company assets being purchased are taken subject to those liabilities. The company's members ordinarily have a blended ordinary income and capital gains rate because the tax character of the items being sold, the tax character of the income passing through to the members is determined at the entity level and passes up to the members, the same phenomenon that occurs in the case of an S corporation asset sale. Similarly, in the case of an S corporation asset sale, the blended rate is skewed toward the 23.8% capital gains rate as opposed to the 39.6% ordinary income rate. There can be a difference in the seller's blended tax rates between a sale of member interests and a limited liability company asset sale. The difference primarily depends upon the composition of the company assets. For example, on the one hand, the seller accounts receivable may not be bought, or on the other hand, the company is selling considerable depreciated plant, property, and equipment that has high market value. The next item I wish to cover is business entity buying and selling transactional process. You can see from the slide there are essentially 4 stages. There's negotiation. What does that entail, or what should it entail? Well, it should entail a buyer term sheet. That's the fundamental items. The buyer proposes to pay $10 million. The buyer wants to buy the corporation's assets. The buyer wants to close within 6 months or within 90 days, so on and so forth. There's also a letter of mutual intent that goes beyond the term sheet. This is where the buyer and the seller often do purchase price negotiations, time for closing. They get acquainted with whether or not it will be a stock sale, it won't be a stock sale, and so forth. Typically, there's a confidentiality agreement which protects the seller's proprietary rights and financial information. Tax-driven transactional structuring. Well, I've talked about that at length. It's very important, as we've all probably known for some time, but I think illustrated quite graphically today. Due diligence. What's due diligence? Well, anytime a buyer buys a business, he has to know what it's all about. Frequent buyers, such as private equity funds, have this down to a science. Other buyers, which may be occasional buyers of businesses, looking for synergies with their existing business or looking to expand product lines. Due diligence, very important. It looks at the financials. It looks at the plant, property, and equipment. It looks at a lot of things, everything having to do with the selling company's business. I also put the drafting of the legal documents under this heading because many due diligence matters come up during the course of negotiating the precise terms of the purchase and sale agreement. They come up in terms of exchanging comments on the first draft of the agreement. And so things that didn't come to light concerning aspects of the selling business at earlier point in the business entity transactional process come to light during the document drafting, commenting period, and the negotiation associated with that. When that's done, typically the agreement is signed, and it's typically signed at some point before a scheduled closing date. The closing is when the transaction happens. The property transfers. If it's stock, the stock certificates are endorsed in the name of the buyer and transferred over. With asset transfers, there's more complexity. There might be motor vehicle titles. There might be liquor licenses. There might be professional licenses that have to be transferred. Cash is delivered at closing, usually by wire, sometime by certified check. Buyer promissory notes. I mentioned earlier, sometimes a business acquisition involves not only cash at closing, but buyer promissory notes. There may be other deferred payments. Oftentimes, a purchase price cannot be agreed on. As a consequence, there's a price that's tentatively agreed on, and that's set forth in the agreement. It's paid at closing. But there's something called an earnout, which basically means if the selling company exceeds predetermined targets in a period after the closing, the sellers get additional consideration, other deferred payments. And then finally is the post-closing period. Depending on the transaction, it could take anywhere from 6 to 60 months. You might have purchase price adjustments. Very common. Why? Because the purchase price was agreed to be $10 million, but it was based on a certain level of inventory. It was based on a certain level of accounts receivable. Subsequent due diligence finds out it wasn't so much. Post-closing review of the seller records discloses it wasn't as much as the sellers had thought. Purchase price adjustments. You have something called indemnification claims. No time for me to go into that. You have the concept of completing deferred payments. And finally, in the case of an asset sale, closing the business down. This is all time allows me to address the transactional process aspects of buying and selling a business. Thank you very much for tuning in today.
Thanks, Robert. It looks like we have a question that came in already, but I want to give everyone a moment to type in anything they have. While I'm doing that, I'm going to take a second and stall and remind you about the Handouts tab. I used to get a lot of questions from people about how to download the PowerPoint slides. And so I just remind people now, you can open up your Handouts tab in your GoToWebinar panel, download them right there, or you just wait until tomorrow and we'll email them to you along with the video recording of today's presentation. So there's also the questions tab. If you have a question, type it right in there and I'll make sure Robert answers it. And don't be shy. You're going to get a survey after this is over asking you how you like the webinar. And whenever someone says something like, oh, I wish they touched on X, or I thought they would touch on Y, I always ask myself why they didn't just ask the question. You've got an expert here, so take full advantage of them. And with that out of the way, we'll jump right into our first question that comes from William, who would like to know. Okay, actually, William has sort of a two-part question. And William, what I'm going to do is break it down in half because he wants to know the importance of tax planning in both the sale and the purchase of a business. I'm going to assume those are slightly different animals. So let's start with sales. So how important is it to the seller to plan out their, tax?
Well, if the business sellers wish to maximize after-tax sale proceeds, the sellers have to do some tax planning. The main point of today's webinar was the kind of business entity being sold and the legal form of the business transaction are going to drive the tax consequences. Now, in my experience as a business transactional lawyer, not all sellers wish to maximize after-tax sale proceeds. Not everybody wishes to do it. Some sellers, busy as they are running their businesses, may not be aware that there are dramatically different tax consequences in selling, for example, the stock of a C corporation compared to selling the business assets of a C corporation. Selling a business, it's an extraordinary corporate transaction. It is far beyond the day-to-day operations of a business and really doesn't have much of a relationship to how well and how successfully the business has been operated. It's an extraordinary corporate transaction. Now, on the buyer side, as I mentioned earlier, the tax consequences to the buyer are not as immediate and are not as dramatic as the tax consequences of the seller. Under today's tax law, federal, New Jersey, Pennsylvania, and the way the tax law is going to be next year, if a buyer buys business assets, or in the case of buying stock or buying stock in a CRS Corp and making the 338H10 election, remember, buyers don't want sellers to make 338G elections, but where they make the buyers permitted to, it's negotiated in a stock sale for the buyer to make the 338H10 election, the buyer gets the up to 15-year straight line tax deduction of the purchase price. Now, not all buyers are going to negotiate for that. They're not going to negotiate it for it. In some instances, the buyer wants to buy the selling business, is willing to buy the stock at a price that the selling shareholders are attracted to. The selling shareholders do not want to have the adverse tax consequences of a 338H10 election. The buyer is buying for economic reasons. The buyer is willing to forego the significant tax benefit of the 15-year write-off, and that's the end of it. In many cases, especially where the buyer is not backed by a private equity fund, but is more of a strategic buyer, and if the buyer is tax conscious, then the buyer is going to want to factor in the value to the buyer of that 15-year tax deduction of the purchase price. Therein is the tax planning for the buyer.
Okay. Well, all right. So that being said, I have a question myself. So it sounds like obviously it's very important. That was the whole reason we were here today. When should the tax planning process begin then?
Well, the taxes should be taken into account when the owner of a company or owners of a company come to the point where they decide to sell the business. That's when the tax planning should begin. It doesn't have to. At the latest, the tax planning should begin when a seller or a buyer or both have at least a reasonable range of values for the selling business, tax consequences aside. So often in a business purchase and sale transaction, the parties will discuss a range of possible prices for the business. Maybe it's 8 million, maybe it's 10 million. In my examples, I've used 8 million, 10 million, and so forth. At that point, the tax planning at the latest should come into play. What does it involve? It involves after-tax numerical hypotheticals, performing after-tax numerical hypothetical pro formas. If we sell the stock after federal and state tax, approximately what are the after-tax proceeds? If we sell the corporate assets after asset sale, after liquidation, what are the after-tax proceeds? Is one or more of the stockholders in a position to have a residency location between the time the corporate assets are sold and the corporation liquidates? People in Florida, stockholders who live in Florida, pay no state taxes on receipt of liquidation proceeds from a New Jersey C corporation. Same with Pennsylvania. So that's your timing. You got to take the taxes into account early stage. If you as the selling business want to have more after-tax sale proceeds.
Cool. Well, Robert, it looks like you explained everything so perfectly that previous one was the only question that came in, so might as well bring things to a close now. Don't forget, all of you will be receiving today's webinar via PowerPoint slides via email, and when you close out of the webinar, a survey will come up on your screen that we hope you'll fill out so we can understand how to best provide you important information in a webinar format. Our next webinar, In the Know, Effective Pre-Employee Screening and Post-Employment Testing, will take place on Wednesday, December 6th. You can register right on our homepage at njbia.org, so don't forget to check that out. So until next time, for Robert S. Schwartz, this is Vinny Civitello, thanking you for being with us this morning and wishing you a great day.